Welcome to episode 3, where we will talk about fair value gaps and the weekly and daily bias. For those who don't know yet or haven't watched episode 1 and 2, I will definitely recommend you watch those two again so you have a deeper and clearer understanding of internal, external liquidity, market structures, and maybe even some strategies, okay? Some strategy outlooks, inlooks, I don't know what you want to call them, but some nice informations. Also get the second episode to 10k views, and I will drop additional 13 videos about 13 different models on 13 different time frames or time zones, times and whatever for you. So I will drop them for you so you can then choose between those models which suits best for you on your time, your platform, whatever you want to trade, and to your lifestyle. The first picture here, you see fair value gaps. Okay, a fair value gap or a bullish fair value gap is the opposite, where an upward price surge creates a gap between the lowest price of one candle and the highest price of the next candle. This gap serves as a potential support zone or resistance, whatever, so you want to react from that area, as internal liquidity, where price may retrace to fill before continuing this bullish move. Both gaps represent inefficiencies in the market that often get revisited, and the bearish fair value gap occurs when there is a price imbalance created by a rapid down move. Same for the bullish, where it's a rapid up move, leaving a gap between the highest price of one candle and the lowest price of the next. So you have 3 candles and a gap between those. These are fair value gaps. You have them in bearish and bullish scenarios. And on the bearish scenario, you also perfectly see internal to external liquidity, since you come into the fair value gap. For those who may be a little bit intermediate, you see that there are 2 fair value gaps, but the bigger one, or the one higher up, is the one that we want to target, because we know PD areas exist and we want to sell in the premium. The FVG continuation trade, a fair value gap is only considered valid if it is not rejected by price action. However, if the gap is rejected, it can then be treated as a level of support or resistance, whatever you want to call it, or maybe a breakable block, whatever, acting as a pivot or important zone for price movements. Okay, so this scenario, often referred to as a breakaway gap for ICT students, allows traders to utilize the gap like a ping pong level, where you then come back and react from it, trading away from it as the market respects the zone, offering the key trade opportunity. On the left, in the middle, you see a bullish example where you may have fair value gaps, but the candle that should respect the fair value gap closes above with a nice inducement. And inducement is simply a big push, big bulky candles, and you induce above and you close above, same as candle closes. Okay, so you also can add the candle close principle to fair value gaps. And then since this fair value gap now got invalidated, it can be treated as a support and resistance area, okay, to take then buys. Same for the sell. You have your nice imbalance. You have a bearish candle that closes below the fair value gap, or imbalance, or busy, or zibby. These are all the same. I like to call them fair value gap because it's the value between 2 or 3 candles which isn't filled, which contains a gap. Then we have 3 types of fair value gaps. There is many ways you can envision a fair value gap, also with just wicks or smaller ones or IFVGs or whatever. These here are the most common ones and will work 90% of the times if you use them correctly. So I want you to combine these with market structure, internal, external liquidity. So liquidity is the key factor here, and also the continuation trend in fair value gaps. You have fair value gaps, which are completely normal fair value gaps between 3 candles. You have volume gaps, where there was just too less volume and market dumped, skipped, or maybe just pushed on another level. and the wicks touch, market rebalanced a little bit, but there's still volume left inside it. And also there are gaps. Sometimes gaps can occur in market when, for instance, Friday closes, Monday opens at another price level. Okay, happens maybe 90% of the time, but you just don't see it because your broker draws in random candles. But if, look at, I don't know, NASDAQ or whatever, or higher pairs like gold, you will most likely see gaps because the market runs still. There is no closing time for a market. Gold still gets traded and EU still gets traded. It correlates with a lot of other pairs, and the dollar, EU or euro and the dollar still share its values. But still on the weekends there's just no nice clarification or signification on the charts because markets are, and that word, closed and open at a different time level. For the weekly bias, which is the most important since there's no real daily bias, when determining the weekly bias, I prefer to analyze and give the analysis then of the weekly candles, focusing on whether a candle range theory, a CRT, setup is forming using straightforward CRT logic. Or alternatively, you can assess the candle closes, apply the power of 3 framework, or utilize the open high low close, open low high close principles to refine the bias. Here you see one weekly candle broken down into the 4-hour time frame. Please mark that, that's important. And for those who listened and wrote down everything I said, you may know here that you have Monday consolidating, then spiking higher. Monday gives you the high at 9 a.m. Happens sometimes. Then market pushes lower. Wednesday gives you a simple continuation trend to the sell side. Thursday dumping the shit out of EU. And then Friday capping off the week. This is simple open, high, low, close. This is simple AMD. This is simple market maker models in the weekly time frame, which we will go over in the next episode. And for those who watched episode 1 and 2 have already known, the first week or the second week will most likely form the high or the low of the month, or the first few days will most likely form the high or the low of the week. Okay? For the daily bias, we come back to the candle closes. Personally, I determine my daily bias by analyzing candle closes. Okay, I just look at key levels and whether a CRT has formed on the daily or weekly. If, for instance, I don't know, Monday is ranging and Friday was ranging, then I simply wait for Tuesday to grab one side of Monday or Friday. And for those who say then, but Clay, I don't know my bias yet. Yes, you don't know your bias, but you know everything else I taught you right now. You know that there's open, high, low, close. You know that there's power of 3. You know that there are candle closes. You know that there are manipulations. You know when time this occurs, and you know everything in the technical analysis way and trading community out there that you need to identify or to enhance where market could go. So use that, and that's your premise. That's your bias. Bias is like, I don't know, it's a biased word. Bias is a biased word, let's go. Because I like to use premise a little bit more. Premise is the view that you personally have, the thoughts behind your vision on the chart. If I show you a random chart which you've never ever even traded, the only thing that you can do, because you're not emotionally attached to it, I am emotionally attached a little bit to EU. If I look at, I don't know, let's say for instance NZD USD, which I never looked at and never traded, I can only adjust and add and implement the things that I've learned so far throughout this course and add them to this chart and try to hope that everything works out as planned. You can't do anything else. And the candle close theory here is a little bit overhyped, I don't know, because these confluences help pinpoint where the market is most likely headed. It's essentially to respond to the market's movements. Okay, you respond thoughtfully rather than to react impulsively, because if you react in an emotional state, you are unconscious, you are gambling. Okay? Ensuring you a more strategic approach to trading decisions. You will get much clearer results, much clearer mindset, and better at trading if you respond to market. If you look at it and you try to tell yourself, I can't do shit, I can't move anything here, I can literally ride the wave, or I get drowned by it. Getting drowned by it is okay sometimes. I literally just breached my 10K funded account, one of them, which doesn't matter because I still have many left. But looking only at candle closes and only wanting to profit of candle closes will never ever work, because you have to respond with your premise and your technical edge. That's it for episode 3. It's a little bit shorter. I hope you still learn a lot. Backtest this. This episode is full of nuggets, and we will see you in episode 4.